have to participate. So no. So
I would
I
say
don't
okay.
the
know
par
enough
whole
to
life.
I don't know enough to answer, so I apologize.
I didn't hear the question. I apologize.
Okay, so the question is, who here thinks we are looking at the difference between IUL, properly structured, not max funded, but properly structured IUL, and a properly structured and engineered, not max funded, participating whole life. So, in other words, we are not overloading either. We are just contributing $1,000 a month for 30 years. In year 20, which policy, assuming no one has taken any money out, this has just been a savings vehicle, what policy has more cash?
I say IUL.
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 I'm going to go opposite, participating whole life.
Okay, you're going to go par whole life. Sarah, what did you say? Or did you say anything?
I don't know enough,
She's like,
but
I'm pleading the fifth.
right.
Okay.
Participating whole life.
You're saying par whole life, Alex. All right. Okay, well, you know what, guys? Let's just dig in here because I've got both of them. We're going to see this. And this is one of the things that I really wanted to show you guys because I wanted you to see the difference. Because if we can't see it, and this, we're going to get into the weeds with this, but it's going to be very, very good. Promise you that. So here we go. And I'm going to take this out. I'm going to share this, and we are going to go. There we go. Okay. You kids see that all right? So all we did, and by the way, just so you know, these are standard from the carrier, National Life Group versus Lafayette Life Insurance Company, or LLIC, as it were. So we are looking, first of all, the initial face amount that we have with the participating whole life. We'll look at that first. It's 118,703. But if you look after the end of year one, you have a $237,000 death benefit. How did that change? What does that tell us? It tells us we have a 30-year term rider on this, so it won't mech. The IUL will automatically not mech if we choose how to do that. So just so you're clear on that, we're going to be looking at the non-guaranteed assumptions. And let's look in the first 10 years. We have, and this is what I find just beautiful. We put in 12,000 bucks. Do you see my dividend at the end of year one? Does everyone see that? $1,478. What percent is that?
A little over 10%.
Little over 10%? Could it be close to 12%? In fact, I think it's a little over 12%. Right? 12,000, 1,400. Darn close to. That's pretty darn good. Anyone know of an IUL given that? They're capping you at 10, right? Okay. And look at my cash value year one. At the end of year one, 82.69. Okay. Now keep in mind, this is split 40-60. This is Nelson Nash, typical 40-60 base POA split. Okay. Let's go down to year 10. What is my cumulative premium? How much have I put in over the last 10 years? 120,000. What is my cash value? 133,000. What is my death benefit? 463,000. Everyone see that? Okay. Now, when do I break even with this participating whole life policy? Who can tell me that?
Year 5.
Year 5, I have paid cumulatively 60,000, and I have a cash value of 54,000. So I'm still a little under in year 5. And what I mean by that, where's my break even, is when Does the money in my account plus the cost of my insurance work in my favor? When have I officially covered that and stopped paying for life insurance anymore? It's just
Year
about
8.
between, yeah, year 7 and year 8, right? Because I'm
Right.
only about 1,100 here difference, but by year 8, I've paid 96,000 and I've made 98, and I have 407,000 in death benefit. So in theory, how much, Michelle, have I paid for this death benefit?
Sorry, I'm like squinting right now.
Well, let me see if I can make this bigger.
Nothing.
How does this? Oh, also, Michelle, if you're on Zoom, click on the Zoom thing, and I think you can move your mouse up or down and make it bigger or smaller on your screen as well.
Okay, I see it.
Okay, is that good? I
Yeah.
don't want you to wreck your eyes and then get in a wreck when you go out to the
Nope,
restaurant.
that works
Okay.
now. Thank you.
All right, so now we're talking about here. It's you get free life insurance because you've put money in. You've not spent any additional. You've put in 96,000 and you have 98. Now you haven't made much, but it's free life insurance. And now you're going to be making in the $5,000 to $6,000 every single year. Look at what is, and I'm going to ask this, 12,000. The next year I get 19. How about year 10? I'm putting in 12,000. This year I'm getting 63.52. What is my cash on cash return in year 10?
50%.
Yeah. 50% plus.
2.37.
What's that?
Yeah, that's sorry. I was saying the 50% there for because he's only paying half of what he paid the previous year is kind of where we're going with that, right?
Well, so what I'm doing here basically is what he pays here versus every year now. And this year he's going to get a dividend of 6,300. So when I say cash on cash, I mean if you were to pay $12,000 for an investment, Daniel, and a year later get 6,300 in addition, it's a pretty good deal, isn't it?
Then I spent 58, whatever, like I didn't spend 12,000.
What happened is you invested 12, you still get the 12 over here, but in addition, you get an additional 63. That means you've got a 51% return on investment.
Yeah.
Okay. So if you go down now, the magic year is 20 years. My cumulative premium is 240,000. My cash value is 355, and my death benefit is 786,000. You guys see that? Okay.
Because you're getting everything back, right?
Yeah, every dollar you've put in goes into your cash value. Every single dollar that you put in goes to your cash value. Okay. Now let's take a look here. Hold on. I got to fix Michelle's. Okay, there we go. All right. So you guys see this one now. Same thing. $1,000 a month or 12,000 a year. This is increasing for 30 years. Let's look. What is my death benefit?
653,000.
What was my death benefit here?
237,000.
Okay, now here's the question. Which one is better? Or do we know yet? I mean, clearly there is a bigger death benefit here, right?
Mhm.
So let's look at the first year we put in 12,000. How much did we make that first year in interest? Can you guys tell?
We essentially only spent $1,700.
Right. But I made interest. How do you tell how much interest I made?
6.45%.
Okay. But now can you give me that's nice. Hey, she's smart. What's the dollar amount roughly on that? Can you tell? Or what's the easy way to tell without using your toes and fingers? The easy way is this is your guaranteed summary, 99.83. So the difference between 99.83 and 10,342 is your difference. So you're somewhere around roughly 400, less than 400, $350 first year.
So you take the accumulated value minus the alternative accumulated value, and that is what you would get, your interest. Is that right? Or am I way off?
No, you're off a little bit there. So look, let's go back and
Okay.
look. So basically, so do you see this guaranteed? The guaranteed is saying, all right, this is what you're getting at 3% here. So that's the guaranteed amount. The difference here is, see, this accumulated value is different. The difference between this, that's $17 from 10,000. So you're looking at roughly $350 is what you would have made. However, this has 3%, so 350. Now that's half of it. So it's about $700 is what you made on this. And $700 is about 6.5% of 12,000, because that's what you put in. Now, as opposed to 700, as opposed to, that's pretty good, isn't it? 14 versus 7, that's twice as much. Now, here's one of the things. What is my cost of insurance when my insurance is this high? I mean, yeah, it's a beautiful death benefit. But what about how? So let's take a look and say, okay, 120,000, when do I break even with my cash surrender? 120, this is 106,000 the year before. This is 94,000.
9.5
This is, yeah, so we're about 82. Actually, we're just about here at 7 years is where my break even is. Because this is 120, but I've got 1, 2, 3, 4. That's 60,000 difference from that. So that's 1, 2, 3, 4, 24, 48,000 difference. And so 82 versus, so that's right, you're right here at it in year 7. But keep in mind, year 7 was 82. Let's see what year 7 was over here. 82. So, okay. Starting to catch up. By the way, how much cash do I have after year 1 in my our whole life? I've got 82.69. How much do I have year 1?
0.
See that? So which one is better? Ooh, well, that's a great question. And I think Michelle said it before. It depends on what the money's for. Depends on what you're trying to do. Depends on what we need. So in the first 10 years, I have access to 135,000 with my IUL. In my first 10 years, with my participating whole life, I have access to 131,000. 131 versus 135. So as you can see, even though I don't have near as much access to capital up front, it starts to outpace. Let's keep going. Remember what we were down here, 355 at the end of year 20. Okay, and then what is my annual dividend at year 20? $13,000. So I have over 100% now. I put in 12 and I've made 13. So that's a 27,500 difference is what I've made on that. Let's go ahead and look at year 10 here. Down to year 20, 240 gives me how much here?
406,000.
406,000. And what is this? A million. 406,000 and a million. What is this one?
355,000 and 786,000.
Now let me ask you guys this. If you were just looking for cash accumulation for the next 20 years, what would you recommend?
IUL.
The IUL, because the IUL outperforms. Now, let me ask you a question. What if over the past several years, there has been economic turmoil and the market has been going crazy, up, down, left, right, all over the place? What are my options?
Well, par life would have a steady 11% every year, whereas you might have 0 years with the IUL.
Mm-hmm. So even though it doesn't go down, it's still, when we look at the path it takes, it could be that the par whole life is a more stable vehicle. Now, here's the question that I have for you is, okay, well, if we're going to be looking at this, if I'm going to be looking at, this money,
You just
355,000,
have to look at your
what's that, Alec?
you just have to look in the crystal ball and see what the market's going to do in the
There you
future.
go. Exactly. Exactly. So we've got here with NLG, hey, that's 406,000, but that's assuming 6.45. What if it was zero that year?
Then
Right?
you
Or
can't lose anything.
what if this here was, because what is it, one every how many years the market makes a correction that takes up to 6 months? Every years would be down, taking at least 6 months to correct. 5. So could it be worse than this? Sure. Could it be better than this? Sure. The point is, this has the ability to grow faster, but not as steady. And so now let's take a look as we go to year 64. 360,000 in, 905,000 cash, 1.48 death benefit. We're going to see how this outperforms. What did I say? 60, year 30? 713. What was this one? 905. Ooh, that's almost $200,000 difference. That's like 650,000 or 650, excuse me, 65,000 every 10 years difference. Look at my death benefit, 1.2 versus 1.45. Now, let me ask you guys this question real quick. Why would I not want, or why would I want my death benefit to be higher? Why would I want my death? What is the, besides the obvious of, well, if I die, my family gets that. Besides that, what is the death benefit doing for me financially in this vehicle, Michelle? As long as you have your mic unmuted, I'm going to pick on the unmute. I'm not pick. I'm going to call on the unmuted.
If your death benefit is higher, then the cost of insurance is going to be cheaper.
Well, if the death benefit is higher, which means the cost of insurance is going to be higher, so that would be actually more expensive. But why would I maybe want to pay a little more for that? I think Carrie said it, but let's Daniel, were you saying something?
So
it's
it's
structured,
not, sorry.
when it's structured like this with a higher death benefit, you get the death benefit and the cash when you die.
No. No, you only ever get the higher of the two, by the way. Don't promise people both, or you're going to wind up losing your E&O insurance real quick.
So
Carrie
it's
said,
not,
go
oh,
ahead,
sorry.
Gail. No, go ahead, Gail.
It's not looked at as like a mech. I mean, has to do, not, I mean,
Okay.
I kind of know where I want to go, but my brain's not wanting to put the words together.
No, that's okay. So I like what you're saying though, because yes, it does affect the mech, but Carrie
Mm-hmm.
said it right. Borrowing power. Why borrowing power? What does that even mean? Borrowing power.
When you use the guarantee that you have in your account, they're going to have a percentage that they still want to keep in there. So having a higher death benefit will give you a little bit more leniency there.
So basically, The death benefit, folks, is your collateral.
That's what I meant. Collateral. There we
Your
go.
death benefit is your collateral. And what does that mean? That means that if you have a death benefit of that is greater, because it has to be greater by at least 5 to 7%, Rule 7702, it has to be greater than the cash in the account. Once it is greater than that, it always will be, that is your collateral, which means you are then allowed to borrow up to the maximum that carrier will allow you to borrow, no questions asked, because you have the death benefit to support it. That is why a death benefit comes in handy. Why I would see, because Michelle, I would, if it was lower, let's just take a look here. If we were to look at, let me share this out again, guys. Let's just take a look at what we're talking about here with, hey man. So 1.45 million, but look at the cash I've got now. I can borrow as much as National Life Group allows me to borrow here on this, because I've got plenty of death benefit to cover this.
Mhm.
Right? However, what Michelle was saying is, yeah, but see, at 64, look at how this is going to play out, because we have 9,000 cash, or excuse me, 900,000 cash, and we have a death benefit of 1.483. So what is the insurance company going to use as a number to apply the ART for year 64 at? Just shout it out if you know it.
They're going to use your death benefit amount.
How does the insurance company figure out your insurance cost for that year?
I should know this.
There is what we call, there's a 3-letter acronym, a TLA. Okay, what's the TLA, kids? It is ART. Stands for annual renewable term. You guys have heard of term policies that you can get an annual renewable term. If you go to Corebridge, you guys realize you could get a 1-year life insurance policy through Corebridge? You guys know that? A 1 year? So it's every year based on your age and health, you'll get that. So this is what happens is the life insurance company says, okay, well, anytime you get whole life, there is an ART involved. So they take the cost out of the value you have earned. So watch this. If I have a death benefit of 1.483444 million, how do they figure my ART? Or excuse me, not how do they figure the ART? How do they use the ART to figure what my annual premium cost would be? What do they use? What number?
5%.
How much is the insurance company responsible for if Alec dies at 64 years old here?
1.4.
Okay. How much of that comes out of the insurance company's pocket?
500,000.
Yeah, it's the difference between what, Michelle?
The net and the cash
There you
value.
go. The death benefit and the cash value that's already there, because that's all they're on the hook for.
Ah.
Do you see what I'm saying? That's what they're on the hook for. So they, because you get paid the higher of both. And then so someone says, well, then why the hell do I want an insurance policy? Well, because you get it all tax free. So that's why, one of the reasons why. But that's why your cost of insurance goes down the older you get with a properly structured IUL. Let's take a look here. Do you guys see the difference? Let's just go up and say year 70 or age 75. My cash value is what? 2 million.
Over 2 million.
Death benefit is 2.13 million. What is the amount of insurance that Alec is going to pay for when he's 75 years old if this was his policy?
About 100,000.
His ART, his annual renewable rate is only going to be calculated on 100,000. How much was it when he started out at the very beginning? He had to get coverage for 653,000.
Do you not have him? Is he paying until he dies, or do you have it set?
On this one here, I just have it running out until they die.
Okay.
On both of them, so they're like for like. Which, by the way, if you ever talk to someone and you're doing a policy review on an IUL and you see this thing running all the way out until 100 and something, you need to get that one rewritten quickly. Okay. And the only question you ask is, Alec, do you really want to pay this thing when you're 101 years old? You know? So anyway, I wanted to point that out. That is very, very critical. I mean, take a look here. You're only talking about the difference right here is
$200,000.
$200,000 there. So as you can see, it's going to, and so by the way, let's take a look. And this is what we talked about before. I want to start teaching you guys how to read this stuff, but let's look at this one now. Okay, we're going to go up to, how old were we here? And this Lafayette will stop it just because it's going to mech and they won't do it anymore. So it automatically calculates this. See, it goes from 12,000. And then here at this point, it's going to stop.
Because you also took off the 30-year term too, right?
That's exactly right. If you notice here in year 31, it goes from 1.2 to 1.152. It drops because the term expired there. But we have enough here to cover this. So I want you guys to watch this. Let's say in year 70, what is my dividend in year 70? 31,000. All right, what is my net cash value? 935,000. And this is at age 70. And we're going to do a little comparison here. At age 70, see my cash value?
It's almost a $500,000 difference.
That's right. How much did I make difference here? Well, let's take a look, Michelle. What's the difference between this and this?
About 100,000.
About $100,000. So with my IUL at year 7 or at age 70, I made $100,000. With my participating whole life at age 70, I made $31,000. So then why would someone get an IUL versus a participating whole life?
It depends on when they need access to the money. So participating is for people who might need immediate access versus IUL, you have time to invest.
Perfect. Absolutely perfect, Michelle. If you look here, you're giving up a lot of this for this. Access to cash now. With the participating whole life policy, I can overfund this and literally give you about 93% of your cash available to you at the end of year 1. Okay? You'll have the cash. So what is this good for? Well, this is good for a lot of things. Like, for example, if I'm going to use debt-free life because I'm pulling out policy loans almost immediately, I need cash available. Can you imagine? And by the way, there is another company that I know of who said, "Oh, we're just going to do our infinite banking with National Life Group." National Life Group says they don't even recommend that. In fact, they say, no, don't do that. Can you imagine saying to someone, yep, we're going to do an infinite bank policy. And by the way, this is what you could take out year one. How helpful is that? Oh, wait, I put $12,000 in and I get to take out zero? Oh, sweet. Thanks. Right? So you need to look at how you need the cash and your access to cash, because sometimes it depends on, remember my words, what's the money for? If I want something that is going to give me access to my capital, all while maintaining an undisturbed compound interest and dividend schedule, uninterrupted, this works. The participating whole life works beautifully. Think about this. This person here, let's say when they're 70, they have this much in cash value. And let's say that, well, let's just use 76. They've stopped paying now. Okay. Look at the dividends. They're still getting 43, 45 every year, still getting it, not spending. But now at 76, what if I say, you know what? I'm going to take 500,000 of this scale, and I'm going to take, so let's say I'm going to leave 700,000 in here, and I'm going to take 500,000, and I'm going to go buy myself a fourplex. I'm going to go buy a fourplex where I can put 4 different families in there, get $2,000 a piece, and net 8,000 or $96,000 a year cash flow. Do I have to pay this back at all? Don't have to. Could I? Sure. I don't have to go to the bank to do it. That's my point. So you can have the cash sitting there. You can have the cash working for you. And what you're going to find with infinite banking is that people have a good 30, 40, 50% of their cash value working somewhere else. So for example, let's do some quick math. What is, and I'll stop sharing this now because we can just kind of talk. What is, can you guys see who Fred's texting? Out of curiosity, can anyone else see? What's he looking at? I wonder if we should, hope he keeps it clean. Okay, anyway, so $500,000. If I wanted to borrow $500,000 and I wanted to borrow it from Lafayette at 7%, anyone want to give me an idea of what my debt service would be per year?
35,000.
35,000 is just the interest rate, not principal, but just interest rate, right? 35,000. How much did I say with a 4-unit, a quad, a 4-unit
96,000
residential?
a year.
Yep. So let's say 100,000, just for simple math. What's my debt service is 36,000. So how much did I make on that every year?
65.
About 65,000 positive cash flow. Think about it. I made $65,000 on it. And by the way, how much is that 500,000 making me in my insurance policy? That's still making money, isn't it? So now, yeah, I'm spending 7%, but what is my at 5? That's 25% every year, right? That's my 20. So if I paid 500,000 and I'm making 100,000, it's 25% that I'm making every single year on that. And my money is still making me money at 10%. in the whole life policy. So I'm making 35% and spending 7. What do you think? Pretty good trade-off? Would anyone else run away from that opportunity? You know what I'm saying? But now here's the thing. That's at 76. If we went back to the IUL, can the IUL work the same way? By the time you're 76, absolutely. You better believe it could. And by the way, most IULs, for example, with National Life Group, remember, ladies, when we did our thing yesterday, we could fix the rate to 5%.
Mhm.
So now we're talking about, oh, yeah, we can not only do we have more money to use, more death benefit, and we have a lower interest rate coming back. What is 2%? At the end of the day, you might think, yeah, I'll buy a car at 5% or 7%. I'm not going to sweat it. You put $1 million on that and see what that 2% does. It's a whole different story. So here's the question. When would you do a participating whole life versus an IUL? Michelle said a couple pieces of it. I want to hear someone else say, when would you do, based on this, when would you use a participating whole life versus an IUL? Just based on what we went over today. Carrie.
Well,
I was just thinking DFL for participating whole life and then IUL for retirement purposes, someone long term that will still see the same accumulation.
So Carrie says retirement is IUL, but for debt-free life and other things that we might need to access and pay off because we want to get out of debt between 7 and 10 years, right? I think that's what we all want to. And most mortgages are 30 years. We can get you out of debt in 10 years. So, yep, okay, that's not bad. So IBC DFL for the initial stuff. And then after that, we're going to look at retirement. And by the way, does anyone disagree with that? Or who by show of hands agrees with the principle that Carrie just said? Carrie doesn't even agree with it. Wow. Geez, Carrie. So I'll tell you this, you're exactly right. Now, do you guys remember? You may or may not. So just a second while I pull this up because I really feel that your mind is going to be blowed once you see this. If I can find out where I put stuff. I don't remember where I put anything, by the way. It's like I've got 14 different folders and they all have something that says advanced markets in it. So I'm not sure what I'm doing here. Bear with me 2 seconds while I look for it. Oh man. Found it. Yay. Well, no, I didn't find it. Oh well. Okay. Gail, remind
what?
everyone what our wealth legacy triangle is called.
Fortis.
Fortis. And what does, pray tell? Ooh, you could share and use the little whiteboard thing that I did and hopefully draw better than I do. What does Fortis represent? What are the 3 pillars of the wealth triangle?
Infinite banking, debt-free life, annuity.
Oh man, no, that wasn't even close. That hurts my feelings. No, so so we have the top one. What is the greatest asset that anyone has? What is
Or
your
income.
best financial asset? It's the ability to make an income.
Yeah.
Okay. The ability to make an income. Number 1. So we protect that by what? A term policy with living benefits. If they get sick, we take something where you get 90%. You get a $2 million policy and you write that through Ladder, or you write that through whomever, $2 million policy, and you can get that for $60 for a 35-year-old, $70, whatever the heck it is. And they get sick and can't work because of a critical or illness, or they can withdraw 50% of that. $1 million is going to get them through and cover their income. Number one. Number two, it's the way we bank. Infinite banking, which incorporates debt-free life, because folks, debt-free life or debt-free legacy is just a concept within infinite bank concept. That's all it is. And then the third piece of the legacy wealth triangle is retirement. And that is what? IUL. So if we have our income protected, the way we bank, and retirement, all three, we're talking 3 policies per person. The last one of those we almost did. So we quoted one for, actually, I was going to say with your client, Gail, who we're going to talk to his cousin. With your client, it was that plus an annuity, but he already had the term stuff where he didn't need to do his income protection. So we just kind of, but it was retirement, it was infinite banking or debt-free life plus an annuity. But you're talking about just the AP premium on that is $12,000-$15,000. If you look at the one that Gail did that we're just finally getting to the finish line closing up, that one was 20 something $1,000 AP total. These are, I mean, think about that. $20,000, that's a $10,000 payday for you. How many of those do you need to make a year for? I mean, Carrie, right? That's life changing, right? So this is
100%.
where, yeah, I mean, absolutely. So this is where I want you guys to understand how this works, because do you know that it is okay to sell a person an IUL and a participating whole life and a term policy? Every person I talk to in this arena, that is exactly what I do. I mean, if we say we're going to talk about IUL, this is just one piece to a bigger financial picture. So unless you want to run with just, if you want to ride a tricycle, or you want to sit on a 3-legged stool and have one leg at normal length and the other two not normal, that's going to be a miserable. You can do it, but it's not going to be very comfortable. It's not going to be a great ride. So has this been helpful? Because I wanted to give you some practical things that you can, when people talk to you, like, for example, I think, Michelle, you asked me before, like at the very beginning, well, how do you know when you do this one or this one? Right? I think I've heard that probably from just about everyone. And the bottom line is you'll need to go through and do this yourself and see what this scenario is, because there's a lot of different scenarios. But that's why it's important. Oh, you want an IUL? Okay, how much can you afford? $500? All right, well then let's go ahead and write one up for 500. No, stop. We don't know what you're doing with them yet. We don't know what the money's for yet. If they don't know what the money's for, then I'll tell you what, before you spend a dime with me, why don't you let me coach you a little bit and help you with getting out of debt, or financially helping you strategize. We are, by the way, called financial strategists. Just saying. So we should be able to help these folks that way. Okay, questions. A lot of stuff. Questions. Let's go. I know that there's going to be a lot out there. Alec, what do you got, buddy?
The term policy that you're talking about, is that always inside the company you're writing the IUL or par life? You don't ever go outside of that company to do a
No,
term.
actually, I do. I do. In fact, most times I have. So, for example, the couple that I wrote the $300,000 a year IUL on, I did the term policy internally with National Life Group. But there are people where I've done National Life Group as the IUL and have done Ladder or LGA or whoever, as long as you've got a good living benefit. And by the way, Instabrain, who we listened to today, this morning, they have probably the best living benefit product. They're just a little tricky to get approved. So you have to be, and that's really what it was. Because we had an agent who wrote a lot of Instabrain in the first month, and most of his got declined. Well, it's because they weren't being 100% accurate with what they were putting down. So Instabrain's fantastic. Ladder is fantastic. Actually, Casey Life has very good living benefits with theirs, and their products are really good. So it doesn't have to be. The thing, what I'll tell you that I've learned is as you are packaging this to the client, you need to make sure that they understand what it's all for, because it can get a little overwhelming. Okay, great question. Great question. What else we got, guys? Gail, you were going to say something? No, Carrie, you were going to say something, I think, right? Or no? Was I wrong?
You're right. But I don't know. It's more on a payment situation.
Mhm.
You know, going into the character of the par and then, you know, the IUL. They have to, the IUL, you would have to keep on paying that throughout the years. Now, as you keep on saying, you don't have to. What do they do if they want to stop payments? That's my question, because I get
Oh,
that question a lot.
it's great. It's great. In fact, I think so. Here, the key is, and remember, if you want this policy to stay in effect without paying any additional money on it, what needs to happen? You have to have it the lowest premium ART, right? It's got the cost of insurance has got to be low.
Okay.
So when we set this up, we want to make really sure that it's increasing up until we stop paying. That's why we lock it in with the IUL. We lock it in to be a level death benefit at that point. And you're going to see in almost every one of these we do. Let me think, Michelle, did we do this for someone that I can pull up a illustration real quick and show her? I forget.
We did one yesterday with Gail on the phone. It was for one of the cross. Gail has it.
Oh, Gail has it. Okay. You remember the illustration you were doing yesterday, Gail,
Yep.
that you pulled up? Can you pull that up and share? Because I want to show Carrie what we did as we went through
It was
that.
for that 25-year-old male for $500 a month,
Okay, I'm
retiring
pulling it
at
up.
age 68.
Yeah. And so Carrie, just to let you know, I'm going to show you how this works, because if you structure an IUL correctly, you're only paying while you're working. When I do it for retirement, I only have them paying while they're working, and then they stop contributing. They're done. And then they live off of the investment that they made. And so Gail will pull it up here very quickly, and then right?
Kind of on the same topic.
Yes.
For an IUL, I know you're able to adjust the amount that you contribute each month. Let's say you don't have enough, like $500, you contribute $500 a month, but you don't have enough the next month, you're able to adjust the amount lower. Are you able to do the same with a par policy?
The answer is yes. The question is there's a big difference between are you able to and do you want to,
Well, yeah.
right? And so I'll jump into that in a second. So Gail, let's go ahead and blow that up a tiny little bit, or for Michelle's case, she's going to need it way up there, because we're going to be able to see what color her retinas are here pretty soon. She's going to be so close to the camera.
I think it's the age eyes. They're a little smaller.
So let's go down. Go ahead and go down, Gail, to where we stop paying. And I think that was at year 65. Yeah, there we go, right there. You got it. Okay. Now I want you to watch this, Carrie. Can you see this all right? If you look at 45, age 45, and year 45, age 69, this 25-year-old male has stopped contributing. Now we have him immediately taking out $72,490 a year until I think it was year 100, I believe, if I'm not mistaken.
Yeah, 100.
Okay. Year 100, and then it stops. But I want to go back and I want to show her something. Not only is this, not only are they taking out $72,490 every year of untaxed money by way of policy loan, I want you to take a look at, do you see where it go across and it says 6.41? You see the percentage there? And then if you look next to that, that is your account value of 1.206. And then we have the cash value of 1132. Okay? So I want you to look at this. The cash value went from 1134 to 1132. How much cash value did they lose, roughly?
1,000.
Yeah, let's call it 2,000, 2.3, right? Now, think of this. They lost 2.3 thousand. How much did they pull out?
72,000.
72,000. Carrie, it only cost them 2,000 to pull out 72,000. Okay, let's go down to the next year. Look at, see the 1.2 million. I'm at my account value now, so it's right by the 6.41, 1.206 million. And then the next year, my account value is 1.283 million. How much did my account value earn? Roughly 77,000, roughly. Okay. My account value was 77,000. How much did I take out? 72,490. And how much did my cash value go down from 1.132 to what? 1.130. It cost me $2,000 to cover my cost of insurance at age 70 and pull out $72,490. It cost me $2,000. How long do you think it's going to take for me to drain my account at $2,000 a year? You know what I'm saying? It's going to take a while. So if you go down until he's 70, or excuse me, until he's 100, keep going down, and you'll see this right here. Go ahead and stop there at 104, Gail. Not that this guy's going to be 104 years old, but he's put in 264,000. That's it. He's pulled out 2.6 million. That is 10 times the amount he put in. He's pulled that out. Oh, by the way, tax-free. And how much does he still have in his cash surrender value? 714,000. By the way, do you guys notice what's going on after year 100? What's the difference between his cash value and death benefit?
It's the same.
It's the exact same. It's not only has he finished paying his life insurance now, keep in mind, remember what is considered full life of a whole life policy to the IRS. 100 years. So now we don't need to have the cost of insurance anymore. How much does his insurance cost him after 100?
Zero.
Zero for the rest of his life. Do you see that? And he can still take out all this money. And by the way, take a look at when, not that this would ever happen, but when he's 99 to 100, take a look at that and tell me how much money did he make? 6.9 million to 7.3 million. Do some quick math on that, Carrie. He made $400,000 doing nothing. $400,000. This is the point I'm trying to make. Compound interest, These are numbers after 75 years. We're sitting here. We might as well be saying a jillion, cajillion, bajillion. Like we don't even fathom it. But this is the strength of this. Now, this kid was how old, Gail?
25.
25 years old. And we're talking about when he is 100, it's going to be some ungodly amount. So let's go up, Gail, to let's just pull it into 80 years old. Okay, right there at 80. No, wait, where'd you go? Nope, 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 nope. There you go. Okay, right there. 2.3 million. And the next year is 2.5 million. That's about $150,000 per year. Do you think we should be going out and talking to all of the 25-year-old kids out there?
I was just thinking that, Scott, they spend that on sneakers.
Yeah, they do.
Yeah.
Yeah, they do. This is what I have. My son was 21. He's putting 500 a month into his policy. He's not doing a 401k. He's putting 500 a month in it. Oh, by the way, he's part of the union. He gets a pension. So think about that retirement. He won't even need to touch his IUL. But he's able to pull out 180 something thousand dollars every year if he wants to until he's 100. So this is where and by the way, this is $500 a month. That's all we're talking about. How many of us spend 500 or more on a car? Okay. I want us to look at this and tell me, do you realize that $500 car is worth $2.3 million? Think about this a second. If you've had a car payment of $500 since you were 25 years old, you literally have been pissing away $2.5 million.
You're investing in the wrong vehicle.
That's your exact. Ooh, look at you now. So that's the thing. Listen, folks. You have to tell people, and this is what I say to my kid if they ever go out, or friends that I try to help get out of debt. Like, well, I need a car, so there's my car payment. I'm like, well, I hope you enjoy that $2.5 million car you're driving. What do you mean? No, this is just a Toyota Corolla. It's just no. It's 2.5. This is what we have to see the importance of money. We have to understand this. So I hope this has been helpful. I hope this has been, by the way, no one's gonna get, thank you, Gail, so much for that. No one's gonna get pissed off at you, by the way, if you write a participating whole life that makes them 60% of this versus, what the IUL is, right? Because it's all just illustration. We don't know what the market's going to do, whatever else. Participating whole life is another vehicle that is just safer, easier, better. So that's why I like running with the two. I like IUL and par whole life. For my trust, I have par whole life on all the kids, and then IULs they have for themselves, and I have an IUL with my trust. So that's kind of how that part works. There's all kinds of ways to diversify this stuff. So, all right. Hey, guys, thank you so much. I appreciate your time. Any other questions before we sign off? I hope this has been helpful. I hope this has been I hope this has been something that you guys can use now where it's like, wow, yeah, I can just talk about this a little bit better. So that's what Carrie, it's a little different, isn't it, by the way? A little different this place versus the last place and what you're allowed to do, can do, what they want to share, how they want to teach you. They just want to teach you, here, say this and give it to me instead of why.
Mm-hmm.
I love the whys here. I love the whys here. Yep. And, always learning.
Beautiful.
Thank you.
Beautiful.
Got
Helen,
one
what you
quick
got, lady?
question. I want to run an illustration like that. So it was 20, 21, 500. When did you stop it? At what age?
Well, we didn't stop it on that one. I just ran it straight across just for comparison's sake. But if you run normally what I do for anyone, because see, look, Gail and I have two different people who they're pretty much written all up. They just got to get married and then they're ready to go. One kid is, what is she, Gail? 22 years old, putting in 2,500 a month. And one kid putting in 1,000 a month at 21, 22, something like that. Target
Correct.
premiums are 19,000, 12,000. I mean,
Nice.
we're talking about really nice ones. By the way, they're going to be multi-millionaires, like $4 or $5 million sitting in there when they're 60. Helen, what I would do if I were you is just put one in at a 21-year-old, 500 a month, and have him retire at 68. So stop putting it in at 68. And we know that's when they're going to qualify for normal Social Security, whatever normal Social Security is at the time.
Right.
But
as of right now.
yeah, so but at least just say, look, if your strategy is hope, you're in trouble. So it's time to start doing something now.
Hope and prayer.
Right? So, but that's what I would do, Helen. Stop it there, and then I would honestly run the distributions then from 69 to 100.
Okay.
Because that's what I tell people is like, look, unless you're planning on dying quicker, yeah. I mean, the likelihood of it is, and they're going to have already pulled out about $3 million to that point. So trust me, they'll have enough to last another year or two if they live over 100. Okay.
All right.
Good
Yep,
stuff.
and I'll be certified in October, hopefully, after the Vegas. So I'll be able to write the new wedding couple.
Wait a minute. Didn't we already count that as we wrote that before? No? Darn it. Okay.
No.
Yeah, no, that's perfect. But yeah, so by the way, we have our certification class for the girls that we're doing Monday and Thursday up to Vegas. So security industry essentials. Who's that by? He turns it backwards to security industry. Okay. All right. Perfect. Okay, kids. Good talking to you. And I appreciate every one of you guys. Michelle, Daniel, I will see you guys tomorrow or the next day or sometime, I am sure. Talk to you guys later on. Peace
Thanks,
out,
Phil.
everyone.
Shot.
You bet. Bye-bye now.